In this video, I want to talk about how you could use liquidity as a key factor in stock selection. Using liquidity as a key, crucial, critical factor in stock selection. So, number one here is an introduction to liquidity in stock selection. Introduction to liquidity in stock selection. Liquidity refers to how easily a stock can be bought or sold without causing significant price change. If you could easily buy a stock and sell it without causing significant price alteration, then that stock is considered liquid. It's considered liquid enough. So selecting liquidity or selecting liquid stocks can improve trade execution, reduce cost, and help avoid price manipulation. You want to have your orders executed as fast as possible. Then you go for a highly liquid stock. Immediately you key in your buy or sell order. Within seconds, your orders, will be filled. That shows how liquid the stock is. But if the stock is illiquid, sometimes it might take a long time to be able to execute the order. Sometimes it might even take, you may not be able to carry out the order the same day. It might not be executed the same day. So if you want to go for faster execution, all right, you could then select your stock based on liquidity. Number two, why liquidity matters in stock selection. Why liquidity matters in stock selection. It presents lower transaction cost. Lower transaction cost. Stocks with higher liquidity tends to have a narrow bid-ask spread. Bid-ask here means the difference between the buy and the sell price. Bid-ask spread, reducing cost when entering or exiting a position. So the lower the bid-ask spread, the lower the cost of transaction. There's a better execution. Better execution. In this case, highly liquid stocks allow for faster trades with less slippage, meaning the price you see is likely the price you will get. The price you see is what you will get because you could execute your trades, very easily. You can do that very fast. Then easier to exit position. In the case where you feel the company, maybe there's a negative news, you just encounter a negative news in your news feed and you want to exit your position. If the stock is highly liquid, you can do that quickly. So in a volatile market, liquidity ensures the investors can sell their position without facing a large price drop. Very easily, you can exit the market without experiencing a high price drop in the stock. Number three, key liquidity indicators for stock selection. Key liquidity indicator for stock selection. Average daily trading volume. You consider the average daily trading volume. Stocks with higher average daily volumes are generally more liquid. So look for stocks with consistent volume. Look at the past volume, and then that will guide you as regards to the volume you may encounter in the future. So you also look at a bid-ask spread. A narrow bid-ask spread is an indicator of liquidity. Larger spread can signal, higher trading cost. Look at the difference between, let's say the bid price is maybe $10, and the offer price is $10, maybe 1 or 2 cents. So in that case, the spread is very small. So market capitalization. Large cap stocks typically offer better liquidity compared to small cap stocks or penny stocks. And then you also look at institutional ownership. Stocks with high institutional ownership, that's ownership by big investment firms, pension administrators, mutual funds, hedge funds, you know, tends to be more liquid as institutional investors trade in large quantities. They used to trade in big volume, large quantities. Please like this video and subscribe to this channel if you've not done that. Number 4, how to identify liquid stocks. How to identify liquid stocks. Screen for stocks with high volume. Use stock screen to filter for stocks with high trade volume. Look for tight bid-ask spread. Ensure that the stock bid and ask price are close together, indicating good liquidity. There should be a narrow bid-ask spread. By the time you subtract the buy from the sell price, the smaller the difference, the better. Invest in blue chip and mid-cap stocks. These tend to have more liquidity and stability. They monitor market cap conditions. So even highly liquid stocks can become illiquid during periods of market stress. So it is important to adjust strategies accordingly. Adjust your strategies based on market conditions. Number 5, benefits of using liquidity in stock selection. Benefits of using liquidity in stock selection. It reduces risk of market impact. Reduce risk of market impact. High liquidity reduces the risk of having a significant impact on the stock price when entering or exiting a position, particularly for those who transact in very high volumes. So it do not really have any impact on the stock price, no matter what volume you key in. So increased flexibility. Liquid stocks provide more flexibility in executing trades, especially during volatile market conditions. There's flexibility. Very easily you can go in, very easily you can go out. There's increased flexibility. There's improved long-term performance. Improved long-term performance is a key benefit of investing from utilizing liquidity in stock selection. So stocks with good liquidity are often more stable and less prone to price manipulation. Because of the inherent liquidity, they are less prone to price manipulation, like pump and dump. So in conclusion, liquidity is an essential factor in selecting stocks, helping investors minimize trading costs, avoid price slippage, and ensure smoother entry and exit from positions. Prioritizing stocks with high volumes, narrow bid-ask spreads, and strong market presence for more effective and efficient trade. Particularly if you're a trader. In fact, when it comes to trading, day trading, liquidity is key. You must make sure that the stocks you are buying and selling, is liquid enough. That is what really guarantees profit, in day trading.